Winter. The season in which fund owners incur self-inflicted wounds. Investors who make the mistake of holding stock mutual funds in taxable accounts are at risk of having unwanted distributions dumped in their laps. This often occurs in December. They pay the price the following April. Case in point, the J.P. Morgan Tax-Aware Equity Fund. The name says that it's going to be kind to taxpayers. The reality is something else. The fund has confessed that a fat, taxable distribution of capital gains will arrive before the year is out. If you hold this fund anywhere but in a tax-sheltered account, you will be sharing some of your investment with the tax collector. The payout will come to 21.4% of your account, and you will owe federal tax on the distribution, at a rate up to 23.8%. State income taxes are on top. Fund vendors often telegraph their punches. This table displays other funds that have warned shareholders of impending damage. Sometimes there's nothing you can do about it. If you have owned one of these funds for a long while, resistance is futile. Let's suppose you got into a fund years ago at $20, saw its portfolio appreciate to $25 per fund share, and note that a $5 distribution of capital gains is now en route. If you stand pat, you'll have a $5 capital gain distribution to report. If you flee before the payout, you'll have the same $5 long-term gain to report. How do funds wind up in this situation? By selling portfolio positions at a profit. There are two ways that can happen. One is if a trigger-happy portfolio manager sells winners in order to reinvest in something more attractive. Presumably a tax-aware fund will avoid such behavior. But most funds are rather nonchalant about taxes. The other cause of unwanted payouts is redemptions. When customers decamp, the manager is forced to liquidate holdings in order to cash them out. If he has run out of losers, he sells appreciated stocks. Once the fund has exhausted any loss carryforward, it is compelled to distribute gains on those stocks to the dwindling band of surviving shareholders. Victims include latecomers who are underwater on their fund shares. An actively managed stock fund should go in your tax-sheltered account. If there's no room for it there, don't buy it. Suppose, in our example, you got into the fund at $24 and then it declares a $5 dividend. You could sell before the payout and report a $1 gain. Or you could sell after, getting a $5 dividend offset by a $4 loss on the fund share, for the same net $1 long gain on which to pay tax. It doesn't matter whether you get out before or after the dividend. The key here: the ex-dividend price of the fund, $20, is less than your purchase price, $24. Morningstar reports a tax cost ratio for funds that have been around for a while. It's based on past distributions, but it's a pretty good indication of how much trouble a fund will cause you in the future. Among funds that hold either only U.S.